You ever notice that a credit card is basically a tiny rectangle of future you? You tap it, your coffee appears, and some distant version of you 30 days from now has to deal with the consequences. It is like sending a polite IOU through time, except it has sparkles and airline miles on it. On the surface, a credit card is painfully simple. You buy stuff. A number in an app goes up. Eventually, you pay. Ta-da! But under that little strip of plastic, there is an entire invisible soap opera of banks, networks, algorithms, and one very stressed stick figure accountant trying to decide if you should be allowed to buy a third pair of headphones this month. So, how do credit cards actually work? First thing, when you use a credit card, you are not spending your money. You are spending the bank's money, temporarily. Your card is basically a permission slip from a lender that says, "We trust this person up to this dollar amount." After that, no promises. That dollar amount is your credit limit. It is the ceiling, the "you are done here" line, the financial equivalent of the bouncer at the door. Every time you tap, swipe, or type those 16 digits into a checkout screen, the card is asking one question on your behalf. "Hey, can I borrow this much just for now?" And the bank, somewhere in the background, runs a quick mental spreadsheet. Do you have room under your limit? Have you been paying your bills? Does this purchase look normal for you, or suspiciously like someone bought a jet ski in a country you have never visited? Approve or decline, yes or no? Coffee or awkward? To make that decision, there is a very fast little journey. Imagine you are at a store buying a snack. You insert your card into the chip reader, or tap it, or wave your phone with the card stored inside, like a digital spell. The terminal grabs the details off your card, the number, the expiration date, the security code under the magnetic hood. It bundles your purchase amount with that data into a message and sends it to the store's bank, which is creatively called the acquiring bank. The acquiring bank takes one look and says, "Ah, this is a Visa card, or MasterCard, or some other network." It then punts your message into that network, which is sort of like the postal service for payments. The network knows where your card lives, your issuing bank. That is the bank whose name is on the statement and whose logo is quietly glaring at you when you overspend. The network forwards the message to your issuing bank. "Hi, your customer wants to buy snacks. Amount, this much. Merchant, this place. Cool?" The issuing bank runs checks at lightning speed. Enough available credit? No red flags? Card not reported stolen? If everything looks good, the bank replies, "Approved," and reserves that amount of your credit line. Not fully charged yet, but set aside. A little financial post-it note. "This chunk is taken." Back through the network, the answer goes, back to the store's bank, back to the terminal, which beeps happily and prints a receipt. To you, it feels instant. Tap, beep, success. To the system, this is the authorization step. It is the moment the bank promises, "Yes, we will pay for this." Later, usually at the end of the day, the store bundles all those approved transactions into one big file and sends it to its bank to actually get paid. This second part is called clearing and settlement, which sounds like something pioneers did with wagons, but really just means, "Let us exchange money and receipts." The network shuffles the funds from your bank to the store's bank, minus some fees, and the store finally gets its money. That is when your transaction locks in on your account for real. So, the story so far. You have a line of credit. You borrow against it every time you use the card. The system does a very fancy yes or no dance in under a second. the store gets paid, and you now owe your bank instead of the barista. You have successfully turned "I do not have cash right now" into "I will deal with this later." Progress. Now, later is where credit cards get interesting. Your bank groups all your little borrowed moments into a monthly timeline. That timeline is your billing cycle. At the end of the cycle, they total everything up and send you a statement. Here is what you bought. Here is how much you owe. Here is the minimum we absolutely insist you pay. Here is the much larger number we would love it if you paid. You get a due date, usually a few weeks after the statement is generated. That chunk of time is the grace period. Here is the magical, underappreciated rule. If you pay the full statement balance by the due date, you typically pay no interest on your purchases. Zero. You borrowed money for weeks, sometimes more than a month, and if you square up on time and in full, the bank shrugs and says, "All right, thanks. See you next month." Free short-term loan. It is like holding the bank's money hostage, politely. But if you pay only part of it, maybe just the minimum payment, the story changes. Now you are carrying a balance. And credit card interest rates are not shy, modest little numbers. They are big, dramatic, slightly chaotic numbers. High teens, 20s, sometimes more. Interest is usually calculated daily on the amount you owe, then added to your bill. Carry a balance long enough, and you enter that classic trap where your money is paying mostly for the privilege of owing money. The minimum payment is not your friend. The minimum payment is the bank saying, "Legally, this is enough for today." It is not saying, "Financially, this is fine forever." Pay only the minimum, and your balance shrinks at glacial speed while interest happily throws a party on top of it. Borrowed money. Borrowed money with a cover charge. So, if they are letting you borrow for free when you pay in full, and they are sometimes giving you cash back, miles, and shiny metal cards that weigh approximately the same as a small planet, how are they making money? There are two big revenue streams, you and the merchant. You, if you carry a balance or incur fees. The merchant, every time anyone uses the card at their store. When you pay $10 at a shop, the shop does not actually get $10. The card system shaves off a small percentage first. That slice is called the interchange fee. It is how the bank, the network, and everyone in the payment pipeline gets paid. Interchange is basically, "Thank you for letting this person pay you with borrowed money." The merchant grumbles a little but accepts it because customers like cards and spend more when they use them. Plastic makes the pain slightly abstract. Part of that shaved-off fee funds your rewards, that 1% or 2% cashback, those airline miles. They come from the fees merchants pay and the interest that other cardholders pay. Rewards cards are a team sport. If you are the person who pays in full and harvests points, you are basically surfing on a wave of merchant fees and other people's interest charges. Politely, quietly, but still. Underneath all this is another big concept: your credit score. When you apply for a card, the bank peeks at your credit report to decide how risky you are. Pay on time. Use only a fraction of your limit. Keep your account in good standing, and your score tends to rise. Miss payments? Max out your card all the time or default, and it falls. Your behavior with that one little rectangle affects how everyone else in the lending universe feels about lending to you. Mortgages, car loans, future cards, all watching how you treat this one. There is also the safety net bit. Credit cards, unlike cash, are designed to be suspicious. If your number gets stolen and someone starts buying jet skis and exotic bird food at 3 in the morning, your bank's system notices that this is not your normal Tuesday. It can flag the charges, lock the card, and ask you to confirm. Most places give you strong fraud protection. If you report suspicious charges quickly, you are usually not on the hook for them. The bank and merchant duke it out behind the scenes, and you get a new card with a fresh number, and the same old temptation. Contactless taps and mobile wallets often add another layer by using tokenized numbers instead of your real card number.
The idea is simple. Even if someone grabs the data from one transaction, they cannot reuse it like a skeleton key. Smart security. Same reckless snack purchases. Put it all together, and a credit card is this weird hybrid object. It is part short-term loan, part security device, part rewards game, part adulting test. Swipe it thoughtlessly, and it becomes an anxiety machine with a monthly reminder. Use it intentionally, and it becomes a tool. Free short-term float, convenient payments, buyer protections, and maybe a free flight if you really commit to the points bit. The card itself is the least interesting part. The magic lives in the agreements and the timing and the habits. Borrow money, then pay it back before it starts renting space in your life. Understand that your available credit is not free money, but maximum amount of temporary trust. Remember that flashy rewards live on top of serious math. Or, to put it in stick figure terms, every time you tap that card, tiny cartoon bankers sprint into action behind the scenes, approve your purchase, and then turn to you at the end of the month like, "Okay, your move." Credit cards do not forget. They only wait. The end. Make sure to like, share, and subscribe to our channel. See you next time.